Ladies and gentlemen, good day and welcome to the Q2 and H1FY22 earnings conference call of PNB Housing Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika Gupta Padhi. Thank you, and over to you, ma'am.
Thank you, Margaret. Good evening and welcome everyone. We are here to discuss PNB Housing Finance Q2 and H1 financial year 21-22 results. You must have seen our business and financial numbers in the presentation and the press release shared with the Indian stock exchanges and also available on our website, that is www.pnbhousing.com. With me, we have our entire management team across verticals sitting over here, led by Mr. Hardyal Prasad, Managing Director and CEO. We will begin this call with the performance update by the Managing Director and CEO, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 36 of the investor presentation. With that, I will now hand over the call to Mr. Hardyal Prasad. Over to you, sir.
Thank you, Deepika, and good evening, everyone, and welcome to our Q2 and H1FY22 results. On behalf of the company, I extend a very warm welcome to all of you and wish you all a very happy, safe, and healthy festive season. Before I share business and financial update, let me give you an update on the transformational project in Ignite that the company embarked upon in the last financial year. The phase 1, which was the diagnostic phase of the project, was successfully completed with various projects identified across the value chain of the organization. The phase 2 of the project, which was design and implementation, was kicked off well and is within timelines. The key structural initiatives identified by the diagnostic phase and the design and implementation are: scale up the high-yield affordable housing Unnati business by focusing on Tier 2 and Tier 3 geographies. We are on track to open 13 Unnati locations in this quarter itself. Enhance our core capability of serving self-employed non-professionals across segments. Create different differentiators to remain competitive in salaried segment. This can be generated through enhanced customer experience with improved PAT and revamped digital customer journey. Improved collections and recovery by leveraging digitization and building advanced analytics. We have initiated multiple projects, and these projects are on track to be delivered within this fiscal year. Optimize productivity and right-size infrastructure to derive higher profitability. A core team comprising of senior leaders is in place in the company to implement the identified initiatives. Let me now share business and financial update. With the opening up of restrictions post second wave of COVID, the company registered a healthy 68% growth in disbursements in Q2FY22 as compared to the previous quarter. The company disbursed INR 2961 crore during the quarter, with 96% of the disbursements in retail segment in line with our agenda. With retail focus approach, we were able to control the degrowth in retail loan portfolio assets during the quarter. Our affordable segment, which is the Unnati, is currently at INR 3043 crores of AUM. With focus on the affordable segment, the company has identified 13 locations in Tier 2 and Tier 3 geographies to be operationalized. 6 of these 13 locations are operationalized last month itself. With the opening of field movement and legal machinery, we witnessed improvement in resolutions. The collection efficiency for Q2FY22 stood at 98.3% as compared to 95.4% in Q1FY22. As a result, the retail group gross NPA reduced by a healthy 14% on absolute basis in September 21 compared to June 21. The gross NPA of the company stood at 5.92% as on 30th September 21 on loan asset basis. The net NPA as on 30th September 21 stood at 3.32%. The company, as a prudent measure, has made adequate provisions, and our total provisions to total asset is at healthy 4.8%. In terms of the percentage, the retail GNPA stood at 3.3% as on 30th September 21 compared to 3.8% as on 30th June 21. The corporate book GNPA stood at 19.1% as on 30th September 21 as compared to 15.9% as on 30th June 21 on a depleting book which further reduced by 9% in June 21. The increase in corporate GNPA is from the already identified SICR accounts. The remedial management group continues to work towards accelerated resolution of corporate accounts. The company has seen some positive tractions in two accounts worth INR 359 crores during the quarter. In one account, the resolution plan is finalized by the Committee of Creditors and is awaiting NCLT approval. The account is resolved, however, it will continue to be in our NPA book for some time. For both these accounts on lines of prudence, we have retained the existing provisions. On an overall basis, the company carries 18.3% provision on the loan assets in the corporate book with coverage ratio of 58% in stage 3 accounts. During the half year, the company has sold and received accelerated payments of INR 1214 crores. The corporate book has degrown by 44% in absolute terms in September 21 from March 19. Talking about the liabilities, the incremental cost of borrowing stood at 5.74% for the quarter. The average cost of borrowing declined by 68 basis points to 7.41% as on 30th September 21 compared to the same time last year. The company has maintained liquidity of rupees 5,772 crores as on 30th September 21. On the capital raise, as informed time to time, the board of the company on 14th October 21 decided not to proceed with the preferential allotment of rupees 4,000 crores. The decision was taken considering various factors which are not to divert the attention and resources of the company into protected legal proceedings, no visibility or certainty as to the timeline for judicial determination of the legal issues, and to move ahead to achieve the primary objective of the company to raise capital. The company has filed an application to withdraw its appeal with SAT. Further, the Supreme Court on 20th October 21 dismissed the appeal filed by SEBI, stating that the appeal has become infructuous due to subsequent developments. The company is working with SEBI to close the issue. The company is presently comfortably capitalized with CRAR at 20.66% and Tier 1 at 17.82%. The leverage has come down to less than 6 at 5.89 times as on 30th September 21, with reduced share of corporate book at 17% of loan assets in September 21 from 22% of loan assets in March 20. The promoters and key shareholders of the company have always been supportive of the company. Having said so, the company will work with the board to enable capital to augment growth through other modes. With this, I would like to open the floor for questions and answers. We have the whole management team sitting over here, and thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Doshi from Chanakya Capital. Please go ahead. Aditya Doshi, your line has been unmuted. Please go ahead with your question. Due to no response, we'll move to the next question. The next question is from the line of Gautami Desai from Chanakya Capital. Please go ahead.
Hello, can you hear me?
Yes, we can hear you, but I would request you to speak on the handset mode, please.
Yeah. So we've been hearing of late that some middle management and above people have been leaving from PNB Housing Finance, more so in the last 6 months. So any particular reason for that? Leaving.
Ma'am, churning of an organization is always good. However, as far as the management is concerned, we definitely are seeing some more attrition in the company. However, the top management continues to remain. There will always be a few people who will move out of the organization, looking for better opportunities or for other considerations, family considerations, personal reasons. However, we do not see that it's a very big issue in terms of the attrition. We are continuously monitoring the situation wherever required. We are also going ahead and doing the recruitments. With the business coming down to some extent, we still feel that on the productivity side and on other considerations, the company is well human capitalized and will continue to attract very good talent.
Okay, and sir, the way wholesale has been running down, we believe that there have not been as many mishaps as the market had expected earlier. So at some point of time, would PNB Housing Finance think of restarting the wholesale funding?
At this moment, we remain extremely committed to 3. One is the very clear agendas that we had set for ourselves in January. The second is that the retail focus is very, very strong with almost 96% of the disbursements under the retail. The third is that we believe that we need to deplete the corporate book at this stage. At some point of time, we will think about it, but right now it will be it's a little early to say that whether the company will go ahead and look for that opportunity. Right now, we believe that it is time that we need to conserve capital, and the capital that is freed by the rundown in the corporate allows us to grow in the retail segment. I think that is very critical for the company at this stage.
So actually what we fear is that your affordable as a percentage of the whole company is so small. So even if you have a stellar growth on that side, the overall growth of the company might be extremely limited. And now that, the differential between your borrowing costs and the larger banks, their borrowing costs growing, and plus, the other banks, going so aggressive on home loans, banks and NBFCs, would our business model kind of, allow us to have that kind of growth for the entire company?
Well, actually, if you look at the numbers, and the numbers will be out, and the presentation also will be there. There is a silver lining over there in terms of what we have done in the retail segment. With this quarter, if you look at it, it's almost a flat growth that has come in. So after about 8 or 9 quarters of negative growth, the company has only degrown by 152 or 157 crores. I think that's a strong statement because the disbursement grew significantly. We'll continue to focus on the retail segment. We'll continue to improve. And more importantly, if you look at the past of the company has a very, very strong distribution network. The company has specialized itself in retail, especially self-employed, salaried as well as it is building strength on the Unnati platform. And I don't see any reason with the kind of interest rates that we are now quoting, with the last reduction being done during October itself, that there will be challenges. There will always be challenges with a bank, but I think we are reaching a sweet spot where we should be able to have a complete flat growth, and then going forward we will continue to grow on our asset side. I think with the retail, with the mortgage industry showing very, very good sign, there is room for everyone to grow. We have the right talent, we have the right people working over there, we have the right distribution and the strength to grow. It's just a matter of time that we will be back in the business, and very strongly we will come and grow. But please remember that the company is very, very mindful of the fact that we would like to have a very calibrated growth so that the profitability is protected. So there are two things that we will take care of it. One of them is on the top line. We are continuously monitoring the top line and we will continuously do it. And the second is the bottom line. These two will remain the cornerstone of our growth and the story that PNB HFL will write now.
So is a 15-20% kind of a growth, there in the near-term visibility?
No, we are not coming out with any kind of guidance, because you have seen in the last about 8 or 9 quarters we have had a negative growth. The first milestone is to ensure that we have a flat numbers, and then the growth story will start. Maybe next time when we meet in the next quarter, or maybe in the March quarter, it is at that time that we should be in a position to give you a much better guidance on where exactly we are going to move forward.
Okay. Thank you so much, sir. Thank you very much.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Krishnendu Shah from Quantum Mutual Fund. Please go ahead.
Yeah, hi. Thanks for taking my question. So the very simple question I just wanted to ask is could you talk about a little bit of the spreads and your NIM? How did you look at with the compression in the spreads from 2.8 to 2.3.2 for the quarter? So how do you look at that going ahead? Because we are carrying a retail-heavy portfolio. So, and if I remember, Unnati was supposed to be a high-yielding product. So just some thoughts on the NIM, how we look at it in the next 1 or 2 years, 1 year maybe. Thank you.
So Unnati is something that we are building up. So it's not that we're going to, Unnati is becoming a big share of the entire portfolio. As we would have heard earlier as well, under Project Ignite, we are looking into all aspects of this particular business on a 360-degree basis to build the right infrastructure and the support to go ahead and build this entire business. So today, the business is largely what it is from a retail side and the corporate business. So as we have shared as well, our spread, not considering securitization, is around 2.8. And 2.8 is something that we have consistently maintained in Q1, Q2, and also for the half year as well. And then if you look into Q4 of last year as well, the spread has been on similar lines for the company. So for us, as we build the retail franchise, the yield might come down, but we also get the benefit of lower borrowing costs as we have a larger share of retail, because it opens new avenues to raise funds, whether it's from the regulator, whether it's from the banks instead of PSL borrowings, or through the route of ECBs. So we know that for us, it's the overall spread and margin, which is something which is very critical for us to maintain. And we have demonstrated that we have been able to maintain that healthy spread, which is in the upwards of around 2.5 and plus, even with the lower and downward movement of the corporate book.
Sure. And do we still will we actively pursue securitization in the near future also?
No, we don't intend to progress any securitization in the near future. As what MD mentioned, the objective of this company is to build the asset on our own balance sheet. In his speech, you would have heard that we are adequately well placed with regard to our capitalization. We are at a 21% of capital adequacy with 5.9 gearing, with a lower share of corporate book. So in spite of capital not coming in as a primary way, we are anyway releasing capital with lower share of corporate books. So in a different manner, the capital is anyway getting accumulated and buffered into the organization to enable and progress the retail growth, which is what we are eyeing for. We are not looking for any securitization or any sell down. If we get good opportunity to buy assets, we would like to go and look to buy assets as well.
Sure. Thank you.
Thank you. Anyone who would like to ask a question, you may press star and one. The next question is from the line of Satish Chheda from IIFL Securities. Please go ahead.
Yeah, thanks for taking my question. My question is more towards the competition right now. Since banks are going pretty aggressive on the home loan front. Just wanted some data around what is the level of balance transfers you are witnessing right now, and how would that trend be over the last, say, around 12 to 18 months?
So, absolutely right. I mean, the rates of interest in the market is very, very competitive as on date. And if you talk about the balance transfer BT out, which is happening, is currently 18% of the BT out is happening from our portfolio, which is pure BT. But we are, we are in the process of retaining the customers in a very strong way. And with the current, as you know, as just mentioned by Kapish also, we have reduced the rates in last month only. And we will be able to hold on to our customers and reduce this BT out portfolio going forward.
Sure. So how much of the decline in AUM would you attribute to the BT out right now?
So as I told you, it's 18%. I mean, in terms of values, I don't have the figures right now, but I can give you the figures in terms of value. What are the figures? You're asking for figures, right?
Yeah.
So I don't have the exact figure of BT out in terms of amount. So I'll share with you off the call.
Sure. Okay.
Thank you. The next question is from the line of Subramanian Iyer from Morgan Stanley. Please go ahead.
Hi. Thanks for the opportunity. Just some data keeping questions. So if you can help us with the breakdown of stage 2 as well as restructured loans into retail and corporate, and also what proportion of the restructured has been classified as stage 1. And I have one more question.
Hi. In the retail book, the total restructuring book is 2,071 crore. And in the corporate, the retail book is 336 crore. And majority of the book as of stage 1, it is around 758 crore is in stage 2 of the retail portfolio.
Thank you. And if you can also break up the stage 2 into retail and corporate.
See, these numbers actually we are giving in annual reviews only. So, but our stage 2 has reduced in this quarter for corporate book as well as for retail book.
Correct.
Improvement in the stage 2 for a corporate book as well as retail book for this quarter.
Understood. And just wanted to understand this impact of securitization compression, which has impacted the NII. How should we think about this going forward? I mean, in terms of impact on NII, if you can please articulate that.
It's been a constant endeavor to keep working on reducing our cost of borrowing. As you had heard in MD's address as well, there's been a 68 basis point decline between H1 of last year to H1 of this year. Incremental cost of borrowing is touching around 5.74. So which means that we are working on continuously supporting the two aspects of our business. One is the new acquisition rate, which we can potentially get at a lower rate, and also the element on repricing of my old book. We, as recent as last month, only have reduced our rates to enable repricing at lower rates and retain good customers. So these efforts will help us in getting further traction and retaining good customers in the portfolio, and then enable us to help and retain our good quality assets, so that our securitization assets behave the way they have been envisaged, and I don't have negative impact coming into my P&L for that book. The securitization book has now come down to around 10,500 crore. So we did in history, we have done in aggregate of around 22,000 crore of securitization. That book is in less than half today. So So as the book shrinks further, the impact of that on the P&L will only go lesser, and therefore we'll be able to get our spread and NIM more from the BAU business that we are building for ourselves.
Got it. But should we expect is there a possibility of such further one-off impacts as well?
See, so the one-off impact can only be to the extent that if I have an adverse experience on my runoffs for that portfolio, then of course there will be a reversal on the income that has been potentially factored earlier. But with these efforts, we do see some traction which should help us in arresting these runoffs in that particular book in particular.
Understood. Thank you.
More particularly as you see the markets are moving towards a little hardening side, these hardenings would also help us getting ourselves more competitive compared to others, and the gap also narrows down for us to be more attractive when I'm offering in the market.
Understood. Thank you. And just to summarize then that basically this one-off impact is largely because of say runoff in the portfolio as well to a certain extent.
Yeah, the one-off impact is largely because of the adverse behavior of the securitized portfolio, which is causing this reduction on the income there.
Hi. One additional piece of information on the restructuring. In the retail of 2,071 crore, which I talked about, around 700 plus is SICR, is in the stage 2. Of that, 500 plus odd crore is because of the SICR.
Understood. Thank you. Thanks for the data, and wish you all the best.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, sir. Thanks for taking my question. Sir, is it possible to talk about, some of those corporate accounts that have slipped for you during the quarter? I'm not sure if you already covered it during the opening remarks. Which accounts were those, and which state? If you could just give some qualitative color on the accounts which have slipped in your portfolio.
So what we can just tell you is that it's just a single account which is moved. It's a 159 crore account which is moved into NP only, and that was already part of the SICR which we had declared in March earlier. So nothing new which has come out. It is just one account which is forward flowed.
Sure. All right. So the second question that I had was on the disbursements. I'm not sure, and please correct me if I'm wrong, but I recall that in the past you've guided for about 15% growth in disbursements in FY22. I understand we are in consolidation mode and our EVM has been declining. But given that we did about 10,500 crores in FY21, we have done about, I think, 4,700 crores in the first half of the year. Do you think we can kind of reasonably do anything between 11,000 to 12,000 crores in this financial year?
Yeah, so absolutely right. We have been talking about that we will be talking a growth of 40 to 50%, and we still stand by it. There is no doubt on that because the market has improved. If you see, overall sentiments in the market have improved, and people are going out and buying properties and all those things. A lot of transactions are happening in the market. That's the overall economy factor that is playing one. Internally also, we have done a lot of changes in terms of sourcing business. So, if I can talk about all those things, maybe we have reduced the rates, as I said earlier also, and that gives us a lot of impetus in the market to go out and source good quality business. Second, yes, we have opened a little bit of market for our builder segment, which is on retail side, and on third, we are coming out with a lot of some kind of changes in towards sourcing pattern for our customers. So that's all these things are happening, and obviously we have got a vast distribution, which is always our strength. It's just about time we start, taking advantage of that, and we are go all out in the market. And yes, we, as you know, we have always been very aggressive on giving us those stats and all those things in the market, and we'll maintain that. And these numbers will not be a problem going forward.
Sure. Sure. And I might sound a little bit critical, but just trying to understand this better. Most of the other housing finance companies, the two largest, housing financiers in our country, and if I kind of even look at some of the smaller affordable housing financiers, everyone talked about very, very strong demand momentum in housing finance during Q2 and something which continued in October as well. I think we have had a fairly stable leadership team, at least over the last, let's say, two to three quarters. Then what is it that is still kind of holding us back? We're seeing improvement on the cost of borrowings. We are targeting a slightly different customer segment than what we did in the past. Then what is it that is kind of holding us back, at least in disbursements? I understand the book could continue to run off. There could be higher BT outs because there is a lot of aggression from banks and larger HFCs. But what is it that is holding us back on disbursements? And maybe another question for Mr. Prasad. Sir, I understand this might be a little bit of a sensitive issue, but the fact that we have kind of decided that we will not go ahead with the announced capital raise and that we will be kind of looking at other alternatives for this capital raise. Did today in the board meeting we kind of sit with the board and present what are the other alternative options which are available? And if you can just show some color from your perspective in terms of what are the options which are available and which could be presented to the board.
Yeah, so I'll take the first one and second one, obviously MD sir will take. So on the disbursement side, I think if you have seen the presentation, we have again come out with a resounding numbers for disbursement. We are 50% over last H1 year of FY21. And in terms of logins and sanctions and all those things, we are way ahead of our numbers as well for the business time is concerned. So overall, if you see on the disbursement growth, we are far ahead in terms of logins. We are far ahead, and in terms of sanctions also, we are way ahead of our even business plan numbers. So in terms of, as I said, I've earlier also explained, it's just about time now. We are ramping up things now, and as I said, there was a little bit of difference in the rate of interest between us and the competition earlier. Now even that is also covered to a larger extent. Though I would say yes, we are not there, but yes, we are covered in a larger extent, and we are in a fighting spirit, and we'll do better than what is expected as mentioned earlier, and the 40 to 50% growth we will be maintaining, and that's how we will move forward.
No, which is very important to understand that the company was undergoing a transition. And it has almost reached a level where this quarter, I mentioned to you, there was a flat growth. We have had a very good disbursement if you take into account YOY or sequentially also. So we will continue to work towards that, to grow and to ensure that we have a calibrated growth. Very important for us in our state where we had a corporate capital constraint, we can have only calibrated growth. And that is what the company is very steadfastly doing. So having said that, on the disbursement and on the retail side, the company presently is comfortably capitalized with CRAR at 20.66%. And Tier 1 is at 17.82%. The leverage, actually, because of all that has happened and all that the company has come down to less than 6% at 5.89 times. As on 30th September, the reduced share of corporate book. I think this is very critical, which frees away significant amount of capital to be lent towards the retail. And that is one thing that the company was always looking at. It was stuck with corporate book, utilizing very high capital, and now with the freeing of the capital, we have great opportunity to grow on the retail side. Having said so, the board actually recognizes the need for capital in the medium to long-term basis. And secondly, the promoter as well, Carlyle and other stakeholders have been extremely supportive. I mean, the very fact that we came out with such a large issue is a demonstration of the fact that people and that stakeholders have strong faith in the company. So the need of the capital remains over there. We will look at it and we will take it to the board as and when it is actually required. Presently, I can only say to you that we are pretty well capitalized. The promoters and other stakeholders remain committed towards the company's growth cycle, and at the appropriate time, the company will take it forward for or any kind of mode to raising the capital.
Sure, sir. So fair to say that in the near term, we will not pursuing the equity capital raise, and it will be business as usual, at least in the near term.
No, I am not saying that. I'm just saying that at the right time, we will go back and we will talk to the board to see that what best options we can have. But presently, keeping in view the depleting corporate book, the availability of capital to grow the retail segment, the CRA at 20.66%, Tier 1 at 17.82%, I think the company can look forward for growth at these numbers also. This is what we will continue to look at it. But I'm also telling you that the moment we feel the need to raise capital, we will approach the stakeholders who have been supportive towards the company in terms of the capital raise.
Sure, sir. I think this is very, very useful. Best wishes and season's greetings to you and the rest of the team. All the very best, sir. Thank you.
Thank you very much.
Thank you. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, good evening, sir. So one question regarding the restructuring book. I couldn't get the number. The retail book on the restructure side is 2,071 crores, out of which 758 crores is in stage 2. Is my understanding correct?
Yes, 750 plus odd is in stage 2, which includes FSCR proportion of 550 odd crore also.
Okay, rest of the book is all in stage 1.
Yes, majority is in stage 1.
Okay, and what kind of provisioning have we provided there for the restructured book?
At overall level, for a restructuring portfolio in the retail book, we have around provisions in the range of 12 to 13%.
And corporate side?
The corporate size is 336 crore. The provision would be around 15-16%, sub 20% kind of a number on an average.
Okay, understood. And lastly, on the one-off from the securitization book, can you quantify that? Number one, and the second one, when you talked about adverse behavior, is it that because of the runoff of the book, or you had some maybe on the performance side, the stage 3 and the write-offs were higher than what you were earlier expecting?
Your question, how is the securitized portfolio performing?
Yeah. So when you said there is a adverse one-off related to the performance of the portfolio, what is the parameter where because of which you have to take the one-off adverse impact, and can you quantify that?
No. So the securitized portfolio gets an adverse impact because of two elements. One is that when I'm securitizing the portfolio, at that point in time we have a history of its performance with regard to its life. And if there is because of BT pressures, if they are running off sooner, then there are potential future earnings which I will not get in my book, and therefore I have to undo the entire working here, because of which the P&L gets impacted. So that is the adverse impact which I was talking about. This portfolio is a very, very high quality and I would say gold standard kind of a portfolio, and therefore the asset quality here is very good.
Okay.
There's absolutely no doubt about the asset quality part of this book, and that's precisely why this is on target as well with regard to acquisition by others. And that's the only element that I was talking about with regard to the adverse impact. So whatever we envisage with regard to runoff experience, it's actually more than what we had factored in our working when we did this sell down of portfolio.
Okay, understood. And possible to quantify that for this quarter? How much was the impact?
So the impact for this particular quarter with regard to the income reversal or unwinding is around 61 crore.
Okay, understood. That's very useful. Thank you very much.
And last quarter this amount was 18 crore.
Okay, good. Thank you.
And just to tell you, in the last fiscal, in FY21, same quarter, with the widening, with the reduction in MCLRs of the banks, we could earn more from these assets because our yield was not going down, and that resulted in a positive experience of around 105 crore. So the anomaly between quarter 2 of this year to quarter 2 of last year is a differential of around 150 crore, 166 crore, because it was 105 crore positive compared to a 61 crore negative.
Understood. Understood. That explains it. Thank you. Thank you very much for that.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. Firstly, in terms of Unnati book, so when we look at the scale up, in fact, that seems to be like tapering down. Maybe it went up from 1,700 to 2,600, 2,600 to 3,000. So we saw almost like 400 crores of accretion last year during COVID. And in the first half, no doubt, first quarter would have got impacted, but still that's hardly 60, 80 odd crores. So I'm not able to get as to what is actually hampering the growth in that segment when it is such a focus area. And when do we see the scale up happening on the Unnati book?
So on Unnati book, if you talk about, in same time last year, we were at AUM of 2,787 crores. And currently we are at 3,043 crores of AUM, which is a 9% of increase, on AUM side. And yes, we are opening up, as mentioned earlier also, we are opening up location branches, which will be Unnati specific location and branches. And from there, we will be definitely getting. So we are in a process. So that's why this transformation team, Ignite team is working on, where we will be getting on to this piece and we're taking up very strongly in future. Currently, the infrastructure and everything remains the same. We are working on the same structure. Going forward, we are building onto it and we'll make a real big portfolio out of this Unnati business.
The only thing was March to September.
Kunal, just one thing.
Yeah.
In January, we decided that we will actually bring focus on the retail book with special emphasis on the Unnati portfolio, which is the affordable piece. Now, having said that, we have started working on it. You would appreciate that it is a completely different business that we, as against the kind of business that the company was doing. Company was between mid and premium segment, which it was doing on the salaries and on the self-employed, and it has decided that it is now going to focus on the Unnati affordable piece. So first thing that was done was to create a vertical within the chief sales officer. The vertical was created to actually start monitoring those. So we first of all started concentrating and building the portfolio and sourcing the business from our existing branches. Now, with this time when we, along with the results, we have told that we are going to open 13 branches, out of which 6 branches were opened last month. Now, it is not just opening of the infrastructure, it is actually that you have to create the separate kind of a sales force, the underwriting team and the collection team also. So it is definitely going to take little bit time, but we might be able to reach the inflection point in the next 3 months, and it is at that time that you will see the build-up of assets that are taking place.
Sure. And second question is with respect to the corporate. So compared to 31st March, wherein we used to disclose the breakup between retail and corporate, stage 3 used to be 12 and a half. Now it is almost 20. And when we look at the breakup, now what we or maybe the disclosure wherein we say that 65% is say 0 plus. So should we broadly assume that maybe there would have been forward flows from stage 2 and even from stage 1 to stage 2 and stage 2 would have been broadly be flat, or overall stage 2 plus stage 3 there would have been an improvement compared to March? How should we look at it? Because I think that number is still, I think it's going up in terms of maybe non-zero DPD. So I think stage 2 is also getting stickier, plus the flows are there into stage 3.
No, so there is definite improvement there. We've given out two numbers. One is 75% of the book as in 30th September is stage 1. And out of that 19% separately stage 3. So stage 2 has actually improved and moved into stage 1. There has been an improvement there.
Okay, so then maybe it's overall 75, so broadly 25 between stage 2 and stage 3, of which 20 is in stage 3. Then stage 2 ideally should have been down compared to what we have disclosed in March.
Hi, Kumar. Let me just rearrange the number a little bit for you. Look, the portfolio attrition is a deliberate activity which